Good afternoon. The time is 4:30 p.m. and welcome to Field Fisher's hosted webinar, Financing Development in a Period of Sustained Low Commodity Prices. Today, we'll be covering a number of the options potentially available to companies seeking to raise project finance for field development. As everyone will appreciate, the world of oil and gas has changed quite dramatically over the space of a few months, brought about not just by COVID-19 and the global recession predicted to follow in its wake, but also the recent face-off between Saudi Arabia and Russia competing over market share. The combination of the two led to the recent very sharp fall in the price per barrel. This acted as a shock to the system and kicked off serious talks to reduce supply, effective from the 1st of May, and which has led to a fairly speedy recovery of the price, with Brent trading this morning at around $42.80. On the 4th of June, OPEC met to continue with the policy of extending through to July the 9.6 million barrels per day production cost cuts. If the foregoing is the current backdrop, the challenges that E&P companies face have not changed since 2015, when the last serious collapse in the price of oil occurred, and possibly have increased, what with greater focus now on renewables and green credentials, the need to implement and maintain high standards of ESG, and rising environmental awareness, all of which affecting public sentiment towards the sector. Achieving generally accepted commercial levels of return on capital remains challenging when the value of the commodity being produced continues to swing dramatically. Although most analysts predict the growth in oil prices over the next decade, these predictions were made before the impact of the coronavirus on the global economy, so all must be treated with caution. Of course, the great irony in all this is that we are being told that money has never been so cheap to borrow, but getting your hands on it has never been so tough. This has never been true for small to mid-cap companies seeking project finance to develop reserves, and the focus of this webinar will be to look at a number of these areas, including Nordic bonds, which have gained in popularity over recent years. Today, we have three experts in their field, each with extensive oil and gas sector experience, to talk about accessing finance in their specialist areas. Ollie Abel-Smith, a partner of the Field Fisher's London Banking and Finance Department, expert in debt financing, will be discussing the various forms that exist in this area. We'll also hear from Dougal Moulson, a partner in Field Fisher's London Banking and Finance Department also, who's expert in derivatives and structured finance, and he'll be looking more at production-based financing. And I'm very pleased that we're also joined by Geir Evenshog, a partner with the Norwegian firm Schott, based in Oslo, in their corporate M&A team, and an expert in Nordic bonds, who will be looking at the contribution these types of bonds can play in raising finance. But before we start, I should quickly like to explain how listeners can ask a question of the panelists. On your control panel, to the right-hand side of the screen, you will see questions and chat box. Please drop this down and send your questions to us throughout the webinar. We will have a Q&A session at the end, where we will try and answer as many questions as we can without going beyond our allotted 45 minutes for this webinar. If we are unable to get to your question, we will follow up with you via email after the event. So Ollie, if I could turn to you first, can you take us through the various forms of debt financing that might be available to developers?
Thank you, Stuart. I'm going to cover project finance, reserve-based lending, and pre-export finance facilities. Turning first to project finance, compared to other infrastructure-intensive sectors such as power and utilities, project finance, in the sense of non-recourse or limited recourse structures, has been less widely used by the oil and gas industry. An upstream facility is capable of, but doesn't always lend itself to being project financed. Why is this? Project finance models look for stability. Future revenue streams are typically less stable and predictable in oil and gas projects than for large-scale infrastructure projects, which may have regulated or inflation-linked returns. Oil and gas projects can bring substantial logistical, infrastructure, and social issues, and the track record across the industry of completing projects on time and on budget is not necessarily favourable. I'm going to touch on some of the commercial and other risk factors. The strength of the security package over the project company and project assets is obviously a key concern for lenders. Lenders are also concerned by what protection in practical terms the security provides. Stepping into a part-developed project is an unattractive proposition Other factors look to the stability of the project, in particular factors such as the quality of resources and reserves, the technical challenges of the project, the track record of the management team, and the likelihood of cost overruns and delays in reaching commercial production, and the political and fiscal stability of the country concerned. Banks provide the majority of the capital. However, the ever-increasing pressure on banks to maintain their capital ratios puts pressure on banks in providing long-term finance. Both export credit agencies and development finance institutions have a role in providing support for transactions. ECAs and DFIs are becoming more flexible and prepared to work alongside commercial banks. ECAs use loans, guarantees, or insurance to promote the export of a particular country's national goods. They don't support a particular importer or exporter. Rather, they deploy capital to promote the country's trade policy. On the slide is a quote from the UK Parliament Environmental Audit Committee's report in June last year, investigating the scale and impact of UKEF's financing of fossil fuels. This highlights how an ECA's participation gives comfort and facilitates the involvement of other providers of finance.
Ollie, could I ask you a question on that? Is there a common framework for environmental and social governance issues in project finance?
Thanks, Stuart. I think the short answer is no. Different institutions may adopt different approaches. The equator principles are the most commonly referenced framework in project finance, which are a risk management framework voluntarily adopted by financial institutions. They apply to 4 financial products, including project finance, and are subject to certain value thresholds. However, the approach to covenants addressing environmental and social risk and governance are often adopted in corporation facilities, even where the loan may not necessarily fall within the criteria, or whether or not the institution has adopted equator principles. So also just picking up on DFIs. DFIs active in the oil and gas sector include the AFC, IFC, and EBRD. The involvement of DFIs reduces associated political risks given their standing and relationships with host country governments. Their involvement also comes with requirements of strict compliance with environmental and social standards. And just coming back actually just very briefly to ECAs, another aspect of that Environmental Audit Committee report highlights is that the pressure on ECAs to align themselves with national and international climate objectives and obligations. The committee's report recommended that the UKEF should end support to new fossil fuel projects by 2021, and the UKEF should align its work with achieving net zero emissions by 2050.
Okay, thank you very much. Let's move on.
Thanks, Stuart. Moving on to reserve-based lending. Mid to large cap independents are perhaps the largest users of RBL facilities. These players typically use RBL structures for development financing and general corporate purposes. RBLs enable the raising of debt across a number of assets at various development stages and retention of a degree of operational flexibility. Structures have developed differently between the longer standing North American markets and those financed internationally. The key features of an RBL in an international project context are first, commercial banks make funds available to cover capital expenditure, operating expenditure, and development costs of a number of specified assets. And in doing so, they spread the risk. And for general corporate or working capital purposes. In addition, drawings could cover refinancing of existing equity debt, including bridge finance, or the financing of an acquisition. The available loan commitments usually fluctuate on a 6-monthly basis by reference to the borrowing base amount, calculated using the most recently delivered banking case that covers each of the included oil and gas fields. This would typically identify the net present value of future cash flows from each field, taking into account their current status. As commodity prices fluctuate, so too does the available loan commitment, as this will feed into the determination of projected future revenue. For the purposes of determining the borrowing base amount, RBL lenders considered only proven and probable reserves, not possible and contingent reserves, and the extent to which projected production figures enable debt service. Banks typically require loan tenors to match production profiles as lenders seek full repayment by the early of the reserve's tail date and a short to medium-term maturity of 5 to 7 years. Next slide, please. Thank you. The typical financial coverage ratios are loan life cover, which is the ratio of the NPV of projected cash flows for the period to the maturity date of the loan to the outstanding amount of the loan. Project life cover, which is the ratio of the NPV of projected net cash flows for the period, and this can vary, to the date on which field costs are greater than revenues, again to the outstanding amount of the loan. And the debt service coverage ratio, which is CFAD's, the debt service requirements in the calculation period. A robust security package will typically be required, covering secured project accounts through which revenues are to pass in accordance with the payment waterfall, security over borrower shares, borrowing group assets, including licenses, GOAs, PSAs, project documents, insurances, and hedge agreements. There will be a fixed amortization schedule and prepayment of cash, so i.e. a cash sweep, to the extent that the outstandings of a loan facility exceed the borrowing base amount. And there are often detailed provisions on the ability to add or dispose of the field assets on which the borrowing base is founded, subject to various conditions being met, including in relation to the provision of security and ability to service debt. Turning now to types of production financing, the main categories are PXF, prepayment financing, streaming, and royalty arrangements. Typically, in each case, the off-taker's payments or notional payments discharge the loan amount for prepayment or upfront capital amount. I'm going to pick up on PXFs. So, as indicated, at its simplest, a PXF is a loan secured against receivables. The classic PXF structure, finance structure, is as set out in this diagram. The producer enters into the financing directly with the lender and is the borrower for accounting purposes. The producer enters into an offtake contract with a third-party offtaker or any number of a panel of offtakers. The offtakers pay for the oil directly into a collection account, which proceeds, or a portion of them, are then automatically applied to repay the lenders. And the lenders take a security package comprising an assignment of the benefit of the offtake agreement, a charge over the proceeds of the collection account, and quasi-security in the form of guarantees to mitigate against production risk. Next slide, please, Stuart. So what are the advantages of PXF? Strong off-takers have better credit ratings than the producers. They're often in a more favorable jurisdiction than the producers, and this mitigates the lender's commercial and country risk. PXF is considered by banks to be a form of secured financing, although no physical security over the producer's tangible assets is taken. PXF provides cash which would otherwise be unavailable through opening up a wider group of lenders and keeping lenders on board who have exhausted unsecured borrowing limits with such producers. And the fact that cash was provided offshore was generally very attractive to lenders, mitigating again country risk and in many cases the associated currency control repatriation issues. Turning then on the next slide, please, to some of the issues. Having a bankable offtake contract is core to a PXF structure. Lenders are looking for greater risk sharing, which can be achieved through long-term offtake contracts. So typically it is expected to be in excess of the duration of the financing and not terminable or capable of suspension, and to mitigate payment risk by ensuring the quality of the offtaker and the terms of the offtake. Commodity price and currency risk is obviously a factor, although hedging can go a long way to mitigating this risk. PXF only works if there is a reasonable certainty as to the production and delivery of the product, otherwise there aren't any cash flows. Examples of factors which contribute to production and delivery risk include the technical capability of the production facilities and their operators, and competing demands on production, so i.e. the overcommitment of goods to delivery contracts. A suitably strong parent or producer can provide a performance guarantee to mitigate against these risks in part, not completely. Finally, legal structuring risks include jurisdictional issues such as central bank approvals, ability to grant security over accounts, and local requirements to repatriate proceeds from exports, and also export controls and others would include sanctions and change of law risk and environmental liabilities. With that, I'll pass on to Stuart.
Thanks, Ollie. A lot of information there, a lot to take in. Again, listeners are encouraged to ask questions. Send them through to us and we can see what time we have at the end. But thank you, Ollie, on a very good presentation. Lots of information in there, lots of useful stuff. Moving on, now to Dougal, who will speak more about prepayment financing and streams. Dougal, please continue.
Thank you, Stuart. I'll follow on from Ollie's conversation about PXF and RBLs, and as I think listeners will hear, some of the features of prepayment financings will sound familiar. A prepayment financing is where finance is provided to a borrower to make payment for goods in advance of their delivery. So whereas a PXF is a financing secured on future receivables, a prepayment facility is effectively a sale and purchase arrangement under which a producer receives an advance payment, which is in substance the loan, against a commitment to deliver a fixed amount of product in the future, typically priced on a benchmark basis with a fixed discount or a premium. Next slide. Thank you. So this slide illustrates a somewhat complicated and arguably atypical structure. In the center, you'll see the buyer. Contrary to a PXF transaction, the direct provider of finance to a producer is not usually a bank or a financial institution, but is more commonly a commodity trading company. It is the commodity trading company who would make an advance payment to the producer. This can be documented as simply as by inserting an advance payment clause in a contract of purchase and sale. But more frequently, this will be documented in a prepayment supplement or in a prepayment facility agreement between the buyer and the producer, which sets out more fully the terms on which the advance payment is to be made, the terms on which it is to be reimbursed, and other terms such as representations, warranties, and covenants, and events of default, and cover ratios, similar to what one would see in a loan agreement. Reimbursements of the advance payment are usually made by delivery of commodity to the buyer. The invoice value of the commodity delivered in a given period, typically 1 month, is deducted from the reimbursement installment due at the end of the month. Where there's a shortfall in the value of commodity delivered, the relevant installment usually has to be repaid in cash. Now, although not illustrated in this diagram, the buyer may take security over assets of the producer, or over shares, over rights under contracts to secure the reimbursement obligations, much like in a PXF or in an RBL. Now, the diagram here shows lenders to the buyer taking a certain number of security interests, but in fact, the key collateral from the perspective of the lenders will usually be the rights of the buyer itself under the prepayment facility agreement and the commercial contract with the producer. The lenders will also wish to be able to benefit directly or indirectly from any security granted by the producer in favor of the buyer. The structure may or may not involve hedging arrangements, and there may or may not be a collection account. This can depend, among other things, on local currency control regulations. Where the buyer is set up as an SPV, which can sometimes be the case where, for example, there's more than one trading company participating in the financing and they wish to have a common vehicle, there will usually be a final off-taker, and the structure will look quite a bit like a PXF in that case. Where the buyer is a commodity trading company, there won't necessarily be any specified final off-taker in the structure. Could we go to the next slide, Stuart? Thank you. So as I say, prepayment facilities are similar to PXF. The main difference being the central role of the buyer, typically a trading house. A trading house could be preferable as a counterparty from the perspective of bank lenders, preferable to the producer, that is, particularly when producers are located in emerging markets. Trading houses, particularly the largest trading houses, can be seen as quite acceptable credit risk from the perspective of banks who might have large funding lines available to them. The prepayment structure can also result in a reduction of country risk, similar to PXF in emerging market contexts, as the trader or SPV are located outside the producer jurisdiction. Prepayment financings can also be compatible with credit insurance taken by the ultimate lenders on the underlying producer, which is another helpful feature of these structures. One can sometimes see large trading houses provide a full package of debt funding, a long-term offtake, marketing arrangements, and in some cases, even equity.
Okay, Dougal, before we go on to the next slide, I'm not a banking lawyer as such, but it sounds to me that trading houses are very similar to banks. What's the difference?
Well, I think it's fair to say that some of the trading companies function to a certain extent like banks. They have quite large financing teams who are active both on the lending side of their transactions, but also on the borrowing side. It's important to understand that the trading companies generally work in partnership with their banks and other funding providers on prepayment financings. They could borrow from their own funding providers on a full recourse basis, in which case the trading company will usually have more freedom to structure the prepayment financing as it sees fit. Or they can borrow on a limited recourse basis, in which case the ultimate lending banks or other funding providers will tend to scrutinize the underlying structure more closely, but they'll still often be guided by the trader as to what kinds of structural protections are or are not appropriate or commercially feasible. Can we move to the next slide? So here we summarize some of the advantages and disadvantages of prepayments. One of the disadvantages from the perspective of the producer is that the debt funding tends to be intrinsically linked to the offtake. If the offtake falls away, so does the debt funding. And the offtake terms are not always as attractive as in cases where the finance and the offtake are not connected. Sometimes, in effect, the cost of funding will be embedded in the pricing for the purchase. Prepayment financing is also not a solution in and of itself for development financing. It has to sit alongside or be provided after development financing, because the appetite of prepay funders for construction development risk is sometimes limited. Next slide. Thank you. Here we have a longer list of the advantages and disadvantages and the interests of a trader in providing a prepayment financing as opposed to a commercial lender's position. I'd suggest, Stuart, that we move on from this one so that we don't run out of time. Now I'll say a few words about streams, royalties, and what I would say can be sometimes more complex financing arrangements. Streams, in particular, are tailored financial arrangements which can be negotiated on a case-by-case basis. Royalties, on the other hand, tend to be somewhat simpler, although really what one calls a royalty in a stream is up to the participants to decide at the end of the day. Both royalties and streams provide an entitlement to cash payments, which are determined typically by reference to the amount of oil or gas production from a specific field, multiplied by the relevant percentage of the entitlement of the royalty or stream that's been agreed upon by the parties. They tend not to result in any ownership of the underlying oil or gas field. So as a result, they don't tend to be subject to the risk of cost overruns, operating expenditure costs. So they're not equivalent to an operating interest. They're an economic interest. They typically provide some exposure to the upside of commodity price, reserves, and production, but they can also provide downside protections against those variables depending on how the parties have decided to structure the arrangements. Streams are often given in a context where the oil or gas company has a funding need, which of course there are many, whereas royalties sometimes arise on inception. It can be as simple as a license fee for having the right to exploit the land or mineral rights. Streams can include credit-like protections, such as security interests, often second ranking behind the security interest granted in favor of an RCF lending pool, or perhaps in favor of bondholders. And as I say, they are highly tailored arrangements, combining elements of debt, equity, and even derivatives. They're complex financial instruments with complex legal documentation, and one cannot generalize as to their content. They need to be looked at on a case-by-case basis. They're sometimes marketed as being attractive from an accounting perspective because they can be structured in a way so that they're not treated as financial liabilities. Instead, the accounting treatment is akin to deferred income. They're also attractive because they give the producer access to a diversified source of funding. Therefore, the producer is not solely reliant on its banks or the capital markets. But like prepayment financings, streams are not a solution in and of themselves. They typically sit alongside another form of funding in a package. And Stuart, I think on that point, we can move on.
Well, it looks like we got to the end of your speech there, Dougal. Thank you very much for that. Again, lots of information, lots of questions perhaps to be posed, and I would invite the audience to write in with their questions. So at the end, if we have any time, we can look at certain areas a bit further. Now, moving on to our last presenter today, I'd like to welcome Geir Evenshog, who's going to discuss Nordic bonds. This is an area where he clearly has some great expertise. And Geir, I'd like to ask you to take us through, perhaps starting with a brief overview of the Nordic bond market itself, and then tell us what's so attractive about them.
Yes, thank you, Stuart, and hi, everyone. Yes, as you said, I thought it was it might be useful to start with some basic background information. You know, at the end of 2019, the Norwegian high-yield bond market had outstanding total amounts of about 262 billion Norwegian kroner, which amounts to approximately 22.5 billion sterling. The investment-grade bond market is about the same size, by the way. New issues in 2019 came in about 74 billion NOK, which is then approximately 6.4 billion sterling. And we have seen the same level of new issues in both 17 and 18. So that's been fairly stable for the last 3 years. A typical size range for a Norwegian high yield bond is from about 100 million Norwegian kroner to up to 3 billion. 3 billion would then be 260 million pounds. We see larger bond issues, but they are rare. And if you go above 3 billion, it becomes a bit more complicated, and you will typically turn to the US markets. Investors are, of course, Norwegian and Nordic, both institutional investors and also large family offices, but there are a large part of US and actually Asian investors into this instruments. And to a lesser degree, other Western European investors. The bonds themselves may be denominated in NOK, obviously, but it's quite flexible, and you typically see a lot of bonds being denominated in US dollars and euros, but of course also British pounds and sterling is possible. The Norwegian bonds are based on standard loan documentation. I will revert briefly on that later on, but it's important to note that tailor making can take place, and with respect to oil and gas issuers, that is quite often the case as well, because these issuers, they will require either specific financial covenants or carve-outs from the standard documentation. Next slide, please.
Okay.
During 2019, we saw the spreads dropping throughout the year. We haven't got a lot of data from 2020 for obvious reasons. The market has been closed, but I do think it's fair to say that there's a general consensus now that the market is open, and we do expect to see quite a lot of activity, especially during the second half of this year. With respect to 10 years, the Norwegian high yield bonds will typically have between 4 or 5 years. We do see 3 years. We see even 7 years, but you should expect you know, the most of the bonds to have 4 or 5 years tenure. With respect to covenants, and this is different from, for instance, the New York high yield bonds. Norwegian bonds are typically structured around maintenance covenants and not incurrence tests. What you see on the screen is up to 2018, but we have seen the same in 2019 as well. So it's fair to say that they, to a large extent, are structured around maintenance covenants. So next slide. What about oil and gas bonds? Well, if you look at the total market and you look at the different sectors, if you combine the oil service and the shipping and the oil and gas sectors, they amount for more than half of the total outstanding volume. And oil and gas alone amounts to approximately 11% of the total volume. And this has been fairly stable over the last 5-6 years. With respect to new issues, oil and gas have moved from just 3 or 4% of the total volumes in 16 and 17 to 16% in 18 and 19. So new issues represent a larger share of the market recently. We have issuers from Norway, the Netherlands, the UK, assets spread around actually in the world. We have obviously Norwegian continental shelf, the UK continental shelf, assets in Denmark, Netherlands, Germany, different jurisdictions in Eastern Europe, Kurdistan, and some others quite exotic jurisdictions in Asia. And we have issuers which are both producers and issuers who are just dealing with exploration or development. And I think it's also interesting to note that we see increased interest from oil and gas companies from so-called new jurisdictions, and that includes both in Asia and Africa and also actually from the US. So, with respect to oil and gas bonds, they are either senior secured, junior unsecured, or they are project finance specific. As I mentioned, we see quite a lot of tailor making for the oil and gas bonds, and obviously there will be less covenants in junior unsecured issues. And of course, we do have in almost every one of them intercreditor issues, either with the RBL facilities or the bank facilities. So the market and the different participants and investors also in Norway are quite used to having intercreditor issues. Independent verification of reserves and resources are not really required from a legal perspective, but of course the managers for the issue may require it from a marketing standpoint. But if you denominate the bonds with more than euro 50,000, then there is no legal requirement for it, and there is no continuing obligations if you list the bonds on the Oslo Stock Exchange to have annual statement of reserves or anything like that. So why Norwegian bonds are attractive? Well, it's the most important feature perhaps is that there is no heavy due diligence involved. There's no 10b5 exercise. There's no formal rating required. The bonds are marketed and issued based on an agreed term sheet and a company presentation. So what you typically will do is that the issuer and the Nordic trustee, which I will come back to, and the managers and the legal advisors will draft up a term sheet which is fairly detailed. They will possibly pre-sound that with some possible investors based on feedback. They'll finalize the term sheet and go to market with a term sheet and a company presentation. So there's no EU offering prospectus. There is no information memorandum which is going to be reviewed by any authorities. You may have a non-regulated information memorandum basically required by the managers, especially for first-time issuers or for issuers which have not listed shares on the regulated market. But you will avoid spending time and money on having an offering document to be reviewed and approved by the authorities. So there's less time from launch to funds received, and there is considerably less cost compared to, for instance, a New York high-yield bond issue. And that's, of course, one of the attractive features of this instrument. And this is, by the way, also, I think, one of the reasons why you will typically only see, well, you will always only see Norwegian investment banks involved in this. You won't see the Goldman Sachs of this world involved as managers, because quite frankly, I don't think they will get this process through their internal compliance departments.
Okay.
But it's,
good. What's the normal timing for the process, and what are the costs involved in all this?
yeah, good question, Stuart. I mean, timing obviously depends on the complexity and where the different underlying assets are, and if it's going to be secured, and if we need to have integrator issues. But I think you come a long way with basically 3 or 4 weeks, and you should then, when you launch, it's fairly quick, because the managers will then they will be confident that they will be able to actually close this. So you typically do an overnight placing of the whole bond issue. Preparations then you should be able to do that within 3 or 4 weeks. Some bonds, of course, take longer because they are complicated and they have lots of either complexity with security packages or integrator issues, but it's a fair statement, I think, to say 3 or 4 weeks. Costs, Norwegian investment banks will typically charge, I don't know, 2-3% of the gross amount, maybe 4%, depending again on the complexity and the size amount. Legal fees, of course, very hard to say, but from a standard issue, I think Norwegian legal fees could typically be around 300,000 NOK, and then you can divide that on 11. And you get, or 11.5, and you get the sterling. And then, of course, a local council come in addition, but it's definitely considerably more cost efficient compared to doing a New York issue.
Okay, thank you for that. That's good.
And also with respect to a listing, if you go for a listing, as you know, most investors into these instruments will require to have a liquid instrument, and if you list on the Oslo Stock Exchange, it's fairly quick. It's cost efficient. I think it's something around £4,000 to list, and then you have some annual fees around £4,500 or something like that, depending on the size of your issue. So it's fairly cost efficient also with respect to listing. All right, next slide, please.
Yeah, my apologies. I think I went ahead there, Ger. That was a very full answer. We're on your next slide already.
Oh yeah, in a way. So a bit more on why they are attractive. Well, I mentioned standard bond loan agreement. This is to a large extent actually LMA based, but it's very, very LMA light. So the bond agreement template in Norway has approximately 40 pages. And of course, you can compare that to a New York debenture. The security and documentation will obviously be governed by local laws. And I think it's also quite important to note that amendments to the bond loan agreement will require 2/3 majority among voting bonds. And then one last bullet on the Nordic trustee, because Nordic trustee is then acting as trustee for something like, I don't know, 95% of all bond issues in the Norwegian market. They have been around for a long time. They're actually today owned by a private equity fund. They used to be owned by Norwegian financial institutions, but they have been around for a long time. They are reliable and acknowledged as the bondholder representative in the market, and they represent then one counterparty, and they represent all investors. So they are one point of contact for the issuer. And if you as the issuer are contemplating doing something with your bond loan, you can always discuss on a confidential basis with the trustee prior to going public or approaching the investors as such.
Do you find them very approachable, Ger, from your experience?
Well, Stuart, this is Norway after all, so it's quite informal. And yes, I do find them very approachable. They will always pick up the phone. They will be interested in guiding you in terms of what's market, what they believe is achievable, what is not achievable. They will, of course, be reluctant to make decisions as such, but they are quite helpful in giving guidance. So that kind of works on a very informal and flexible basis, I think. So the basic point from a legal perspective is that then no single bondholder has any right to take legal action it all needs to be done through the trustee and by bondholder votes. I think that's it.
Okay, thank you very much for that. We do have some questions from the floor. They cover the whole range of talks that we've received, but Geir, in view of the fact that you are still on the platform, so to speak, there's a couple in here. If I could just ask them of you straight away. We've been invited to ask, why are they considered high yield, the bonds that is, and what is their tax treatment? We've got literally only 5 minutes, so if you can be succinct. If it's going to take a longer, we can always send an email, of course, and follow this up.
Yeah, well, quickly on the first one, why are they considered high yield? Well, that depends on how you define high yield, I guess. But it is, of course, quite high risk. There is a lot, as you saw, there are more than half of the outstanding volume is within oil services and shipping, which can either go very, very well or they can go very bad, and the underlying issuers. It's important to note that with respect to oil and gas issuers, there aren't that many examples of really distressed bonds in the Norwegian market. And I don't think we have any real examples of enforcement of such bonds. But it is high yield because of the type of issuers. They aren't investment grade. But as I said, there are no formal rating requirements either. But it's definitely not. It's not. Equinor is not doing this.
Okay. And tax treatment, if you could be very quick. We can follow this up with an email, of course.
Well, yeah. Well, I think it's important to note that there are no withholding taxes as of now, but this is being contemplated in the Norwegian Parliament. And apart from that, it depends on the issuer and the investor, obviously. I'm not really able to give a very specific answer on that.
Okay, well, thank you very much for the explanation so far. We have a question, well, in fact, lots of questions are coming in now, so I'll go with the ones that came in early. What is the maintenance covenant? I think that's Dougal, that's aimed at you.
Well, maybe aimed at Geir actually, but a maintenance as opposed to an incurrence covenant. So the incurrence covenant under the high yield bond market would typically mean that a borrower is not sort of technically prevented from raising new debt without the consent of bondholders. It would be allowed to incur new debt up to a certain point as long as certain ratios are maintained. But it's not typically prevented from incurring new debt, whereas the maintenance covenant is this typical banking market covenant, which would prohibit a borrower from raising new indebtedness other than where the indebtedness fits into a specific basket that the lenders have permitted up front. So the incurrence covenant is typically considered to be a bit more flexible than the maintenance covenant and more typical for high yield bonds, because you can't really get consent very easily from bondholders. So the market is designed to allow people to operate in a pragmatic sense in a capital markets context.
Okay, thank you very much for that. We're running out of time, but there's a question here for you, Ollie. Can banks actually take over or operate a field should the RBL borrower face financial difficulties? And how does this pan out in practice?
Thanks, Stuart. I'll try and just give a short answer.
Very
I think
brief, yeah.
Lenders will look to take a sort of a broad security package and therefore give themselves the broadest set of options when there's financial distress or enforcement. However, I think in practice, where there is financial distress, lenders are much more likely to look to restructure the debt in some form or look for sales of assets to recover on the loan rather than looking to sort of step in and complete a development.
Thank you, Ollie.
And Stuart, sorry, I should correct myself. Sorry for butting in, but actually the main point about the maintenance covenant, it's confusing it with the incurrence covenant, is it is typically a financial ratio that needs to be maintained in order to avoid an event of default in the bank market. Whereas in the high yield or traditional high yield market, there isn't that kind of financial ratio that must be maintained. But the consequence of not maintaining a financial ratio would be that the business would no longer be able to operate as freely as it would otherwise be able to do.
Yeah, and this is a gift from Shut. Just very quickly, I could just add that a typical maintenance financial covenant in a Norwegian high yield bond would be, for instance, that the issuer at all times must have a certain level of liquidity, which means basically free cash, or that it at all times must have a leverage ratio, typically EBITDA over debt, of at least for instance, 2.5 to 1 or something like that. So it's at all times.
Okay, thank you very much for that, Ger. Whilst you're at the microphone, Ger, there's a couple more questions in on Nordic bonds. Can they be applied to the refining sector or to mining? If you could be very quick on that.
Yes, we have seen several mining companies and so on issuing bonds in the Norwegian market. Yes, definitely.
Goodo. And another one, Nordic bonds, could a startup or SME company issue them?
They can and they have. It requires more due diligence from the managers, and they will have more scrutiny, but it's possible, yes.
Okay. A little bit more, maybe a long-winded question. Ger, could you explain what level of risk curve the issuers have to be in order to qualify, development phase or earlier?
Well, if this is relating only to oil and gas, as I said, we have seen pure exploration companies doing bonds. We have seen E&P companies doing project finance bonds with just a development asset, and we see producers. So we have the whole range. So as long as the project is good, and you know, that's the most important thing. So
Okay.
we see, yeah, all phases.
And the final question, because we are now over time, but are ESG requirements becoming more stringent for Nordic bond issues?
Very good question. There's a lot of talk about it. There's no real influence on the terms so far, but we expect this to maybe be more relevant also from a legal perspective in 2020 and 2021.
Okay, thank you for some very good questions there. Thank you very much to our speakers, Ollie, Dougal and Ger, for very detailed, very dense discussions. I mean, if people have more emails, more questions, please do send them through. We will get back to you as best we can. In the time that all we had of 45 minutes, 50 minutes, I think we covered a lot of ground. Hopefully people in the audience have time to think and digest what's been said and how it affects their business and what they're looking for going forward. And thank you very, very much. And there'll be many more Field Fisher webinars down the line. Thank you.